Have you ever looked at your bank balance and wondered if there is one simple decision that could completely change your financial future? Not a risky gamble, not some complicated business idea, just one quiet financial move that slowly turns small money into serious wealth. In this video, you will discover a powerful financial principle that wealthy people quietly use for decades. By the end of this video, you will understand the exact amount of money where wealth truly begins to grow on its own, how ordinary people can reach that number even with an average income, and why starting early can completely transform your financial life. Most people believe building wealth requires luck, a huge salary, or some secret investment trick. But the truth is much simpler. Real wealth usually begins with a small decision and a powerful force called compounding. Imagine you are standing at the top of a snowy hill, holding a small snowball in your hands. When you roll it down the hill, it starts picking up more snow. Slowly it becomes bigger, then bigger again. Soon the snowball becomes so large that it keeps growing faster and faster as it rolls. Money works exactly the same way. At first the growth looks slow. Sometimes it feels like nothing is happening at all. But over time the money you earn begins to earn more money. Then that new money also begins to grow. Eventually the process becomes so powerful that your investments start growing faster than the amount you are saving. That moment is where real wealth begins. Unfortunately, most people never reach this stage. Not because they are incapable, but because they either start too late, give up too early, or constantly interrupt the process by spending or withdrawing their investments. Compounding needs three simple things: time, consistency, and patience. Let's talk about why this matters so much. Many people chase quick money opportunities. Some try risky crypto trades, hoping to double their money overnight. Others jump into complicated side hustles that consume their evenings and weekends. Some people invest in rental properties, expecting easy passive income, but they soon realize that managing tenants, repairs, and paperwork can feel like another full-time job. But compounding works quietly in the background. Once the system is set up correctly, it keeps working even when you are sleeping, traveling, spending time with family, or focusing on your career. This is why long-term investors often appear calm while others panic about market fluctuations. They understand something important. Wealth is not built in weeks or months. It is built in decades. Now let's look at a realistic dream that many people share. Imagine having $1 million invested. That number represents security, freedom, and the ability to make life decisions without constant financial stress. The question is how someone could realistically reach that goal. Let's say your investments grow at an average of 8% per year, which is close to the long-term average return of the stock market through broad index funds. If you had about $240,000 invested today, after 20 years it could grow to around $1 million. But most people do not start with that much money. So let's extend the timeline. If you give your money 30 years instead of 20, the required starting amount drops dramatically to around $100,000. Just 10 additional years cut the required starting amount by more than half. This is the hidden superpower of time. Time allows compounding to do the heavy lifting, but investment returns can vary. So let's look at a few different scenarios. If money grows slowly, at around 4% per year, reaching $1 million in 30 years would require roughly $280,000 at the start. At 6% growth, the starting amount drops to about $160,000. At 8% growth, the number falls to about $100,000. And if returns average around 10% per year, the required starting investment could be as low as $57,000. This reveals something fascinating. Small differences in growth rates can dramatically change the final result. But there is an even more important factor than growth rate: your behavior. Many investors damage their own progress. They panic when markets fall, They withdraw money too early. They constantly chase the newest trending investment instead of sticking to a long-term plan. Every time this happens, the snowball stops rolling. The real secret is consistency. Once you start investing, leave the system alone and allow time to work in your favor. So what is the number where compounding truly begins to feel powerful? After looking at decades of market history, investor behavior, and financial growth patterns, one milestone stands out clearly: $100,000. When your investments reach $100,000, something important begins to happen. At 6% growth, that amount produces $6,000 in the first year alone without adding new money. The following year, the growth becomes even larger because the previous gains are now also growing. After 10 years, the yearly growth could reach around $9,000. After 20 years, it may reach around $16,000 per year. At that stage, the investment itself is creating more money each year than many people manage to save manually. Your snowball is finally rolling downhill with real momentum. But reaching $100,000 does not require a massive salary. It simply requires discipline and a clear strategy. For example, saving $850 per month with a 6% return could reach $100,000 in roughly 8 years. Saving $500 per month could reach that milestone in about 12 years. Even saving $250 per month could eventually reach that goal in around 20 years. These timelines may sound long, but consider the alternative. 20 years will pass whether you invest or not. The difference is whether you arrive at that future with growing investments or with financial regret. Another important myth is that successful investing requires advanced financial knowledge. In reality, many experienced investors simply buy low-cost index funds that track the overall stock market. These funds automatically spread your money across hundreds of companies, reducing risk while capturing long-term market growth. This approach removes the need to constantly research individual stocks or monitor daily price movements. Your job becomes very simple. Invest regularly, stay patient, ignore short-term noise. In fact, checking your investment account too often can actually harm your results. Seeing daily market fluctuations may trigger emotional decisions that interrupt long-term growth. Successful investors often check their portfolios only occasionally while focusing on the bigger picture. Think of investing like planting a tree. When you plant the seed, it does not become a giant tree overnight. At first, it appears fragile and small. Some people might even doubt that it will ever grow into something significant. But as years pass, the roots grow deeper. The trunk becomes stronger. Branches spread wide and provide shade. Eventually, the tree becomes something powerful and stable. Your investments grow the same way. Quietly, slowly, then suddenly much faster than you expected. So remember the lesson behind this entire video. Wealth does not usually come from dramatic financial moves. It grows from simple habits repeated consistently over long periods of time. Start investing early. Stay consistent. Protect your patience. Because one day you will look back and realize that the small financial decisions you made today quietly built the freedom you enjoy tomorrow. And the moral of this story is simple. Money grows best when discipline meets patience. If you enjoyed this video and want to learn more simple strategies about money, investing, and building financial freedom, make sure to subscribe to the channel. Arsam Explains Money, so you never miss the next video that could change the way you think about your financial future.